Imagine waking up, opening your brokerage account, and seeing money deposited into it. Not because you worked overtime, not because you sold something, not because you started a side hustle, simply because you own investments. For many people, that's the dream behind dividend investing. A portfolio that generates income while you sleep. But are dividend investments actually a good idea? Or are investors sacrificing growth in exchange for income? Today, we're going to look at 3 different dividend investing approaches: the safe approach, the balanced approach, and the high-income approach. By the end of this video, you'll know the strengths, weaknesses, and risks of each one. But before we get there, let's slow down for a second and understand what a dividend actually is. Because dividends sound more complicated than they really are. When you buy a stock, you're buying a small piece of a business. Not a lottery ticket, not a prediction. A real business that sells real products and earns real money. When that company earns more money than it needs to operate, it has a choice. It can reinvest those profits into growth. Or it can distribute some of those profits to shareholders. That payment is called a dividend. Think of it like owning part of an apartment building. People pay rent, expenses get paid, and whatever is left gets distributed to the owners. Dividends work in a very similar way. The more shares you own, the more dividend income you receive. Simple. Now here's where things get interesting. Not all dividend investments are created equal. Some prioritize growth, some prioritize income, and some are designed almost entirely around generating cash flow. Let's start with the safest approach. Dividend growth investing. These are companies with long histories of increasing their dividends year after year. Many of them sell products people buy regardless of the economy. Food, drinks, medicine, household products. The income starts relatively small, but over time, the dividend often grows. And the stock price may grow as well. This approach is built around patience. The goal isn't maximizing income today. The goal is building a larger income stream tomorrow. Now let's move to the second approach, the balanced approach. This is where many investors begin looking at REITs and higher yield dividend stocks. These investments generally produce more income right away. Instead of waiting years for dividend growth to make a difference, investors start receiving meaningful cash flow much earlier. The trade-off? Higher sensitivity to economic conditions. The income is higher. But so is the volatility. For many investors, this is the sweet spot, a balance between income today and growth tomorrow. But what if income is the main objective? That's where the third approach comes in. High-yield dividend investments. These investments focus on maximizing cash flow. Yields can sometimes reach 8%, 10%, or even higher. At first glance, that sounds incredible. After all, who wouldn't want more income? But this is where many investors make a mistake, because high yield doesn't automatically mean high quality. Sometimes a stock yields 10% because the business is struggling. Sometimes profits are falling. And sometimes the dividend gets cut altogether. When that happens, investors can lose both income and share price value. This is known as a dividend trap. The yield looks attractive until it disappears. So, are dividend investments a good idea? The answer depends on your goal. If your primary objective is maximizing long-term growth, dividend investing may not be your highest priority. If your goal is building passive income, dividends can play a major role. And if you're looking for a balance between growth and income, dividend investing can offer both. The key is understanding the trade-offs. Higher income usually comes with higher risk. Higher growth often comes with lower income. And every investor must decide where they want to sit on that spectrum. Because successful dividend investing isn't about finding the highest yield. It's about building a portfolio that can continue generating income year after year. Income that grows, income that compounds, and income that may eventually help pay for the life you want to live. But that raises an even bigger question. How much money would you actually need invested to generate $1,000 per month in dividend income? That's exactly what we'll cover in the next video.